So today we're going to talk about the Fed's next big move and my predictions for 2023 because the Fed has 5 big issues that they have to deal with. So just to summarize, let's take a look at the Fed. They've, of course, increased the federal funds rate 10 different times. And this chart exactly shows how they've done it over the year, starting in March of 2022. And then, of course, in June of 2022, inflation was still 9.1%, which is the point of why they're increasing the rates in the first place. But for this video, we're going to talk about what is actually happening as the Fed's increasing these rates and what's going on with the economy. So most of you know that the Fed has 5 big issues: inflation, unemployment, banking, recession, and of course, what are rates going to be this year and into 2024? So this slide represents what the media headlines have been since the Fed's meeting on May 2nd and 3rd of this month. So these headlines, of course, are from your normal, the CNBCs, the Fox, the CNNs, and one, of course, is from BlackRock, somebody that's actually in the game, managing money for everyone. And their opinion is that they don't see the Fed cutting rates at all. So what's the truth here? Is the media correct? Is BlackRock correct? So I decided to dig into the Federal Reserve's minutes themselves, which are sitting on the Federal Reserve's own website. So these are the minutes from the Federal Open Market Committee's meeting on May 2nd and 3rd of 2023. And what's included in these minutes are very different from what you're seeing in the media headlines. The first thing that's clear is the Fed are still committed to the 2% inflation rate, which is all over their website. As you can see here, the committee voted unanimously to increase the rates by 25% in the month of May. There's nowhere in this document that says that they're cutting or pausing the rates anytime this year. However, going back to the media again, as you will see, as I've underlined here, the federal officials were divided over a June pause. The federal officials were less confident. Fed may take its foot off the gas. The federal officials don't agree. Fed is going to pause interest rates. This information does not exist anywhere in the minutes of the Federal Open Market Committee on May 2nd or 3rd. The point here is that the media is saying one thing and the Fed is doing quite another as representing the minutes. You need to be careful on where you're taking your information. So here on page 8, you can see they outline what's going on with the banking, the inflation, and the unemployment. The first thing that I want to draw your attention to is they are addressing the banking situation. They're saying here that they also judge that the banking sector stress would likely continue to weigh further on economic activity, but to the extent of which would be the case remain highly uncertain. But they go on further to say that the underwriting for the banks is going to become harder and harder and harder, which of course we're all seeing today. The second point here is in just another indication when they say, with inflation well above the committee's longer run 2% objective and core inflation only showing signs of moderation, participants expected that a period of below trend growth in real GDP and some softening in labor market conditions would be needed to bring aggregate supply and aggregate demand into better balance and reduce inflationary pressures over time. What this means here is that they believe wages are inflationary and low unemployment is not necessarily good for inflation, which indicates higher rates in the future. The next slide, the Fed actually says it. What they say here is they expect further tightening in bank credit conditions amid already tight financial conditions, which would lead to a mild recession starting later this year, followed by a moderately paced recovery. What they're saying here is they expect the economy to go into a recession. So the definition of a recession are 2 quarters of negative GDP. And as you can see, they're projecting growth of 2024 and 2025 to be below their estimate of potential output growth. The next item is all about unemployment. And some of you know that unemployment is sitting in the mid-3s and the Fed wants it over 4%. What that basically means is there's going to be a lot more people out of work this time next year, and that's not going to be good for many people. You got to ask yourself, why would the Fed want higher unemployment? Why would they want to put millions of people out of work? The reason, of course, is when unemployment is low, it puts a lot of pressure on wages, driving them higher, which is inflationary, which is the whole point of what the Fed's trying to combat with these higher interest rates. I would encourage all of you to take a look at page 3 of the Federal Reserve minutes. What I really want you to take a look at is the yellow highlighted spot at the bottom. I don't know about you guys, but it's clear to me that the Federal Reserve's own minutes reflect one thing, that they expect the peak rate to be maintained through January of 2024. What that tells me, whatever the peak rate is at the time, it's going to be at least 5.25 or higher. And right above this highlighted sentence, you could also see that the probability that the peak rate may turn out to be above 5.25% is actually quite high. So what this statement tells me from the Fed's own minutes in May of this year is that the Federal Reserve believes that 5.25 rate may not be the floor, and that they're going to continue a peak rate through January of 2024, which tells me there will not be any rate cuts, and there may not even be a pause, which is completely different from the media articles that I showed you before. For those of you who might not be in agreement, these are actual quotes of people that are on the Federal Open Market Committee and what they said after the meeting. As you can see, the Dallas Federal chief said he's concerned if inflation is falling fast enough. The Federal Jefferson says he's willing to be patient on the policy. And of course, Waller says, I don't support stopping rates until inflation cools. Waller actually said that he believes that the federal funds rate can be over 6%. Of course, Chairman Powell himself said they're going to continue to increase rates until they reach their inflation goal, which of course is 2%. So what does all this mean? What this means is we're going to continue to have a decline in real estate prices, just like we've been seeing over the last few months. The reason, of course, is as interest rates increase, the mortgage payments also increase, making it harder and harder and harder for people to buy houses. The second point is, as interest rates continue to increase, it will also affect commercial real estate, driving capitalization rates higher and values even lower. The second issue is that the unemployment rate is projected to increase to over 4%, which is going to put millions of people out of work, which is really going to affect the economy, rentals, housing, all of those things. The third thing are the banking concerns are going to continue. So think about it this way. If a bank has a loan at 3% and they're paying you deposits at 5%, the math doesn't work. In addition to that, as these real estate values continue to decline, and those loans start to mature, many of these assets' values are going to be worth less than the actual loans that the bank has on them. Fourth, a recession is probable. It's even in the Fed's minutes. I would expect that. And what we could be seeing is high inflation and high unemployment, which of course is stagflation, but we will all have to wait to see how that plays out. The fifth and most damaging of all is that I do see rates continuing to increase 4 point at least in the June meeting as a result of what many of the federal governors are saying themselves, that they're all solving to reduce inflation, even at the expense of higher unemployment, which is going to push the entire country into a recession.